Welcome back. Is the post-summer slowdown setting in for some of the travel names? Marriott shares on pace for, sadly, their worst month of the year amid fears of a consumer slowdown. Marriott CEO Tony Capuano joins us now on the heels of their first investor day since 2019. And Seema Modi, who follows this beat for us, is here as well. Seema.
Thank you, Tyler. And Tony, welcome to Power Lunch.
Hi, Seema. Nice to be back.
It's great to have you on. You had your analyst day today, and you unveiled some pretty bullish three-year targets, including plans to expand around 270,000 rooms over the next 3 years. Is that irrespective of where interest rates land?
I think so. There is certainly some challenges for new construction, particularly here at home as well as in Europe. But we've got a couple 100,000 rooms under construction in the pipeline today, which should get delivered during the period that we presented during the investor day today. And during the second quarter, we talked about 6.4 to 6.7% unit growth for 2023. And we reaffirmed those numbers today. So when we wake up on January 1st of 24, we will have already delivered the first 100,000 of those rooms that make up that three-year development plan.
Yeah, overall, the response or reaction from Wall Street analysts has been pretty positive to the comments you made today at your analyst meeting. But there certainly has been this active debate around the health of the consumer as we see credit card delinquencies rise, inflationary pressures back in play with gas prices moving higher. What are you seeing, Tony? Is there signs of a trade down, consumer behavior changing amidst the travel economy?
Yes, Seema, it's a great question. We haven't seen it yet. In the second quarter, we saw global RevPAR improvement of about 13.5%. Based on that performance, we guided to 6 to 8% RevPAR growth in the third quarter. And we announced today during the analyst meeting that we saw 8% RevPAR growth 2 months ago. We saw 9% RevPAR growth last month. So we're really not seeing it yet. But to the extent we do start to see a little bit of trade down, it's one of the great advantages of having such a broad portfolio. And one of the things we've been talking about recently was with the acquisition of City Express hotels in Mexico, we've now got a large and growing portfolio in the mid-scale tier. So we think the breadth of our portfolio can certainly accommodate any trade down that might occur in the face of future economic softness.
What about business travel? We're in the thick of the season. Any signs of returning to 2019 levels this year, Tony?
Well, we're watching September closely. Obviously, the fall after Labor Day should provide some really important clues, and we'll look forward to talking about that during the third quarter call. What I can tell you is we sort of break up business travel into two categories. Small and medium-sized business, and then larger multinationals. As we talked about last quarter, the business travel volume for small and medium-sized business was already more than fully recovered to pre-pandemic levels back in 2022. And we continue to see great strength in that segment. We're seeing slower, albeit steady recovery with the big multinationals, but we'll be watching that closely through the fall.
Tony, it's Kelly here. Just a question. Could you talk a little bit about the impact that higher rates are having across the hotel space? Because I have to imagine a lot of these properties, maybe the smaller ones, not necessarily part of the chains, maybe some of your proprietors, that these are financed with a lot of debt. Is that debt at higher levels now? And how does that affect their yields, their profitability?
Well, certainly a tougher interest rate environment puts additional pressure on yields. The one thing I would tell you is we've got a terrific and broad group of owners and franchisees, most of whom have been investing in the hospitality sector for years, if not decades. I think they understand the cyclicality of the sector, and from a business perspective, but they also understand the cyclicality of interest rates. They're not trying to time the market. They're not investing for yields for a quarter or two. In many cases, they're owning these assets for years, sometimes decades. And so it is certainly putting pressure on short-term yields, but I think most of them have a longer-term investment horizon.